All right, I think we are recording. So good afternoon, everyone. My name is Michelle Crocker. I manage the KeyBank Financial Wellness Program. Thank you for joining today's session. Today we're going to be talking about how to take advantage of the low interest rate environment that we're in. So we're going to talk about a few different things. We'll talk about how to leverage your mortgage or your home if you have one, or other ways that you can still take advantage of today's low interest rates. But I always like to have local bankers join me for these sessions. If you joined the last session, the banker that I had join me was in the Augusta area. Today we have a banker from our Bangor area. So if any of you are in Bangor, Sam is local to you. And I'm going to turn it over to Sam just to kind of introduce herself to the group. Sam?
Thank you, Michelle. Hi, everyone. I'm Samantha. I am a personal banker at the Bangor Mid-Mall location. And so what I do mainly is work with consumer products, consumer lending products, consumer accounts. I think what I love most about my job is that I get to work personally with my clients, from a savings account to mortgages and everything in between, and life's obstacles. So that is why I love my job so much, and hopefully get to work with some of you.
Great. Thank you so much for that, Sam. And I'm sure we'll be asking a lot of you throughout today's session. So today we're going to kind of go through the presentation. We're also going to take some questions at the end. So feel free to use the chat box. I did put a message in the chat that says welcome to the chat for those of you that are attending. And if you've used a chat before, you know that you can either chat with everyone, and if you choose everyone, then everyone on the call is going to be able to see your question. If you have more of a personal question and you want to make sure we give you the answer, but aren't necessarily willing to say, hey, Michelle had a question about something, you can send a private chat. You can send the private chat to myself or Sam, and we'd be happy to read those questions anonymously so that we can get you the answers that you're looking for. And in addition to that, if there's any follow-up that's needed after the fact, Sam and I are available as resources. Sam is really the primary point of contact when it comes to, if you actually want to get some advice on your personal situation, but we can certainly direct you to resources that are available, within Key or outside of Key in some cases, that can help you to achieve your personal financial wellness goals. So we put this presentation together. If any of you attended the last meeting, you've probably seen this slide before, but I wanted to include it, for the sake of just being thorough and making sure that we're recognizing that the world has changed, right? So there's been some definite upsides when it comes to taking advantage of low interest rates, which is why we're here to talk about that. But if you're feeling stressed about your financial situation, you should know that you're not alone. 84% of consumers in a recent J.D. Power survey, and this is since the virus, said that they were stressed about their current financial situation. And the reality is that people were stressed before this happened. So in some cases, this just sort of compounded stress. But in other cases, just the uncertainty about what the future brings. So hopefully we'll have some great takeaways for you today, and some action steps that you can take in order to improve your overall situation so that you're not stressed about your finances. So we are going to talk about knowing your options for getting out of debt. If you're carrying multiple, balances on multiple credit cards or loans, it can be difficult to keep track of due dates and minimum payments. And, should I be paying this one before that one? And what's my strategy? And so today we really wanted to just kind of level set and talk about one strategy, which is, how do you take advantage of today's low interest rates and maybe even consider a debt consolidation. So we'll look at some examples of debt consolidations. We'll kind of talk about different products out there in the financial services industry that you can leverage to get out of debt. But again, if there's questions or something on your mind that you want to make sure we get out of today's session, please put your comments in the chat. We'll be monitoring the chat box and available to speak to any of your questions. So consolidating your debt. It seems pretty simple, right? If you have a number of different debts, oftentimes it can make a lot of financial sense to go ahead and, just, have one loan for, a fixed monthly payment. If there's a light at the end of the tunnel, and you're not worried about, making extra payments on this, that, or the other thing, it can actually save you money when you shorten the term of your loan, when you repay your debt, and we'll kind of have some myth busters around, does it still make sense to maybe take a little bit of a higher interest rate on one debt in order to achieve some overall long-term savings. So we'll look at some of those examples. Sometimes consolidating your debt isn't always just about saving money, or saving, interest over time. Sometimes it's just making payments more comfortable. If you've found yourself in a situation where maybe not yourself, but maybe a family member or a contributor to the household has experienced a reduction in income, and maybe it even has some longer term impacts, you might consider a debt consolidation using today's low interest rates, just to make things a little bit more manageable when it comes to what you have going out for payments and what you have coming in for income. So, definitely we'll talk more about that. Sam, can you kind of walk us through, and there's a lot of information on this slide, so, feel free to take your time, kind of going through this, but can you kind of walk us through, what are the different options? Why is secured maybe better than unsecured, and what things should folks be considering when they're looking at various products that are available out there in the marketplace right now?
Absolutely. So right now, with the current situation that we're in, a lot of people are consolidating their debt. And so what people might not realize is there's different ways that we can go about that, that may be better for you. So one way would be the credit equity line. So that one would be using the equity in your home. That would be a secured way of consolidating your debt. And so why you might want to consider using secured over unsecured is the interest rate. Anytime that you do an unsecured loan, like an unsecured personal loan, the interest is going to be higher because, honestly, the risk is higher. Whereas if you use, your home to secure the line of credit, then that's something that we could fall back on. So you're going to pay a lower interest for that. And, right now, equity rates are so good that a lot of people we are finding are going with those as opposed to doing an unsecured personal loan. The difference, I'm going to tell you, it was huge. I know I'm talking, 10 points or more. So.
Great. Wow. So I know we don't have the information up here on the slide that says home equity loan versus home equity line of credit. And I think that that's confusing sometimes. Can you just talk a little bit about the difference between a loan and a line of credit, and what someone might expect to see for terms or even costs associated if they were considering some type of debt consolidation or taking out a loan in either a home equity loan or a line of credit?
Yep. So, and depending on your situation, everyone's situation is different, right? So, a lot of people get loans and lines confused. Loan is one lump sum, and so you're going to get that one fixed rate. If they're at 4% today, that's going to be for the life of your loan. Where as opposed to a line of credit might be a better option for some people because maybe you don't need a lot right now, or maybe you don't need anything right now. So that line is there and it's open. So you don't necessarily have to take it right now. But if you feel like, example, you might lose your job, it's a good thing to fall back on. One of the downsides of an equity line is that you would have to pay, the interest can vary. So depending on when you take it out, so the interest will vary. So, you're playing Russian roulette, and but of course that's all disclosed before you take out the money. But it charges what the rate is that day. So a loan would be one lump sum. A line, you could use it, pay it back, reuse it again. So it's a lot more versatile.
Great. I think you think back to my banking experience, and I think, back to when I was a branch manager, and oftentimes I would see folks that would come in and they would say, okay, I want to take out a home equity. Can you tell me what my options are? I have a fixed expense that, I want to pay off and consolidate some credit card debts that I have. But because I'm having an appraisal done and, all these things, I want to make sure that I'm maximizing the equity that's available in my home. So in some cases, you can actually do one loan application, or I shouldn't say one loan application, one credit pull. You can apply for a home equity loan to cover that fixed amount that you're going to borrow, and ensure that you're taking advantage of low interest rates. And you can piggyback, is what we call it, with the home equity line of credit. So to be able to maximize the equity in your home, and have that available to you in case you have a future need. So an example of that would be, let's say your home is worth $100,000. You want to borrow $50,000 for a project that you've got going on. And with our lending guidelines, in most cases, you can borrow up to 85% of your home's value. So you would basically take out a home equity loan for the $50,000, take advantage of that low fixed rate, and then have a second lien position or even a third lien position sometimes with that line of credit that's available to you for the difference between that $50,000 and the $85,000. So $35,000 line of credit on top of your loan, which, as Sam said, it's a variable interest rate. But what you can also find sometimes within different equity products, and it's important to kind of check with your bank. We can kind of speak with what KeyBank can do, but there are a number of different options out there. You can actually sometimes lock in your balance on that line of credit at a low fixed rate as well, to take advantage of whatever the rates are at that time. So equity products are really probably the most flexible tool that you have if you own a home, to be able to take advantage of some extremely low interest rates. Oftentimes there's little or no cost to apply for an equity type of loan, or at least an upfront cost. So you'd want to make sure you really understand any fees or costs that are associated with an equity loan. Typically, they are going to be maybe slightly higher interest rates than a traditional mortgage, and we'll talk about that in a minute. But you wouldn't expect to have those upfront costs like you might have with a traditional mortgage. Did I miss anything with that, Sam?
No, no, you didn't. The other option in there is a credit card. And most people are familiar with credit cards. They're flexible payment plans. And there are a lot of credit card companies, including us right now, that do have offers out there available to some people. And if you get one, and you need it, I would say go for it, because a lot of them are doing 0% APR. And I've seen them done for over a year. So.
Yeah. 0%. We talked about this on our last call, I think, with this group. 0% is a good strategy. It's not a great standalone strategy, but it is a nice way to, if you can just move something over to a 0% and have it not accrue interest for a period of time, while you tackle something else, it can be a good plan. In addition to, kind of what we have on the slide and the mortgages that we'll talk about in a second, you should always know that there are going to be options available that are specific to a bank, right, or unique to a bank. So it's always good to ask a question if you're not sure if there's going to be an option that's available to you, to see if there's anything else out there. So a good example of that would be a home improvement loan. So most of the time we think home improvement loan equals home equity, right? I have to have equity in my house in order to make improvements in my home. Maybe I just bought my home and I don't feel like I have any equity in it. If you're making improvements on a loan, a product that's available is this home improvement loan that can actually help you basically make the improvement to the home or build a garage. I've seen it used for this purpose a lot. Build a garage, and then later, refinance with an equity product once you have the equity available in your house. Usually, if you're making any type of home improvements, the improvements that add value to a home would be things like adding square footage, updating a kitchen or a bathroom. Those are sort of big ticket items that can add value to your home. If you're replacing a roof or, putting on new siding or even replacing windows, Those are nice, but those are also considered maintenance items. So you want to take that into consideration for your future planning. Those types of things might not add value even though you're borrowing money. So just a little pro tip there. Make sure if you're thinking about something future down the road, make sure you know it's going to add enough value that you'll have the equity available in your home. And so the next thing, to talk about, we talked about this a little bit, is refinancing your home. So you can see here, 4 in 10 homeowners, according to this Zillow group survey in 2017, with a mortgage have refinanced their home at least once, and 21% have tapped into their home equity to take out cash. So we talked a little bit already about the different reasons that someone might consider refinancing a mortgage. Before we get into the reasons though, let's just talk a little bit about refinancing a mortgage and what that means. So if you're refinancing a mortgage and it's not a home equity, you will most likely receive the lowest interest rates possible. That being said, there's typically upfront costs or costs that need to be, if you have enough equity, you can roll them into the loan, that need to be considered when you're looking at a traditional refinance of a mortgage. So typically with a refinance, you're looking at appraisal costs, title search fees, attorney's fees in some cases, prepaids on your escrow if you happen to be escrowing your mortgage. What else am I missing, Sam, that ends up as the closing costs when in a refinance?
You already said the appraisal, right?
Yep, the appraisal,
Yep.
title search.
I can't think of
prepaid interest charges. Typically a mortgage is like, mortgage payments are always due on the first of the month. So depending on when you close, there might be prepaid interest charges. So when you're considering a mortgage, what you want to do is make sure, or a traditional refinance, that the interest that you're going to save is going to outweigh or offset those costs over a long period of time. Usually we don't see people refinance a mortgage traditionally if they don't expect to be in the home for longer than 5 years. It usually doesn't make financial sense to have those upfront expenses or costs because you're not going to hold the loan long enough to be able to recoup those savings. That's typically when we would recommend something like a home equity, which might have a slightly higher interest rate, but you're not holding the mortgage for a long period of time. If you're holding the mortgage for a long period of time, then in a lot of cases it makes sense to just do, bite the bullet and do the traditional refinance of your mortgage. But you can see here on the slide, there's lots of different reasons to refinance. It can be to just obtain a lower rate. It can be to lower your monthly mortgage payment so things are more affordable. We've seen that a lot lately. I think there's been a story recently that someone in your branch shared, of a particular individual that had experienced some serious life changes and needed to make sure things were going to be more comfortable for their family. And so having a lower mortgage payment, spreading that, loan out over a longer period of time, even though they weren't necessarily consolidating other things, just made sense for, the situation that they were in due to a health issue. Sometimes people will refinance a mortgage because they want to convert from an adjustable rate to a fixed rate. If you're an adjustable rate right now, you're probably in a really good place because rates are really low right now. That being said, they really kind of have nowhere to go but up. So it might be a good time to say, how can I lock in my balance? How can I take advantage of today's low interest rates and maybe move it to a fixed rate that I know isn't going to adjust again over a period of time? Because we know, historically, interest rates kind of ebb and flow. And so, it's always good to take advantage of when they're low and be able to lock in those savings. Number 4 reason to refinance your mortgage is to access cash. So, we talked about debt consolidation. You can actually, consolidate debts, pay off debts, take advantage of some savings, and I'll show you that in a minute. But in addition to that, you might have something that a big expense. You might have a large purchase that you want to make. You might be considering, like I said, building a garage. You might want to, buy a boat. And those are also, big ticket items that you can kind of pay for, and sometimes refinancing a mortgage can make that a little bit more comfortable. I know when I bought my first house, my husband is in the, well, he was in the service industry. He had a big tool bill, which I hated. And so when we refinanced in the beginning, I made sure we paid off that tool bill because I didn't want that hanging over my head. It was a big, you know, expense that we had, and I just didn't want to have that extra payment. So that's another good reason to refinance. Sometimes we refinance to shorten our mortgage term. You want to be careful with this. If you've got 5 years left on your loan, again, refinancing might not make the most sense because you've already paid a lot of that interest. But if you're just a few years into your loan, you can actually experience some significant savings just to shorten the term of your loan. I know I've seen a lot of refinances where folks, especially now, have gone from a 30-year mortgage to a 15-year mortgage and saved years off the loan and really didn't have a huge impact or maybe even sometimes a positive impact to their payment because interest rates are so very low. And then the last reason is to eliminate private mortgage insurance. So if you're not sure if you have private mortgage insurance, it will show up on your monthly mortgage statement. And private mortgage insurance is really just insurance for the bank because when you bought your house, maybe you didn't have 20% down, and so there's been this extra amount of your payment that is allocated towards protecting the lender. And if you've fallen below that 80% loan to value or even go into an equity product sometimes, you can eliminate that insurance, if you will, off your payment, and then you can, either have a lower payment or have more of your payment going towards principal than other expenses that aren't really gaining you anything. So I know I just talked about a lot of information. So Sam, I'm going to give you the floor to kind of talk about your experiences, now in the environment that we're in today. What are you seeing the most of? What are people doing? What questions are people having?
Refinance every day. Every single day we have people calling. We're working on it constantly, and it's really a mix, and it depends on what your needs are. Whether or not you need the cash out, whether or not you want to, shorten your term on your mortgage. Because even right now, you might realize that you're in an industry that you're not going to probably lose your job, maybe you're making more money, and can afford to shorten your term. So it's refinance every day. And really it's for all of these reasons. And you just check with your bank, check with us, because things are changing daily. And, some days, mortgage typically is lower, but I did just have a client that actually got a home equity line of credit for less than they would have a mortgage and got a cash out on it. So you just never know unless you ask.
Wow, that's pretty amazing. A home equity that had a lower interest rate than a mortgage.
It was amazing.
Not necessarily heard of, but that's good. So, with that, I guess we can just move forward into, when does it make sense to consolidate? So I've got this example on the screen, and I'll let you guys just take a minute and kind of look at this example. I was a little bit shocked when I saw this example because it really paints the picture that we need to understand the full, debt scenario or the full financial picture before we can make the right recommendation when it comes to debt consolidation. So oftentimes what we see as bankers, and Sam, you can probably speak to this, is people will come into the bank and they'll say, I want to pay off my credit cards. I am, consolidating, I'm simplifying, I want to make things easier. And so they might come into the bank and looking at this example, they might say, okay, I've got these 2 credit cards, I owe $7,000, my interest rates are really high, and I'd like to consolidate those 2 credit cards into a personal loan. What have you got for me? And so a lot of times when we see this, and this is across the board, the age-old question comes up of what's your debt-to-income ratio? Are you going to be able to support a payment that is a fixed payment when your minimum payments on these credit cards, probably aren't that aggressive? And so if someone asks to consolidate 2 credit cards and they also have, let's say, a car payment in this example, their income may not support 2 loans. Their income may not support a credit card consolidation loan and then an auto loan. The debt to income ratio just might come in a little bit too high. So that's why I say it's important to kind of look at the whole picture. So you can see in this example that this individual, may not have had the best credit when they got their auto loan, or maybe they just got their loans when interest rates were a little on the higher side. But they are paying 8.5% on an auto loan, $15,000, and $7,000, with an average interest rate of, let's say, 20% on the credit cards. If we were to do a consolidation, assuming that this person was just making minimum payments on the credit cards, they're actually going to, even though they experience an increase in the interest rate on the auto loan because we're consolidating into a personal loan, they're going to pay it off 12 years sooner, and they're going to save $126 a month. So I'll just pause for a second and let you think about that. Common sense, you wouldn't think, why would I take out a higher interest rate on a loan amount that's double what I owe on those other credit cards? That doesn't even make any sense. But when you look at the numbers and you look at that blended savings, it actually does make a lot of sense to consolidate different types of secured debt with unsecured debt in order to be able to take advantage of today's low interest rates. And I know that we do this a lot with mortgages, Sam. Do you have any examples that you can share, maybe a little bit more recent, maybe with some more recent looking interest rates of someone that you've been able to help recently?
Yeah, so I did have a client that came in for, it actually was a debt consolidation. And a lot of times, when we go and we uncover all of what they have, you find a better solution. So instead of us just being like, okay, let's do the debt consolidation, let's do it. We looked at, what's your rate on your mortgage? And so by refinancing for them, and getting them a lower interest on their mortgage, they were able to cash out and pay off those debts, which in turn saved them, tens of thousands of dollars on interest for credit cards. So it was a huge win for them.
Great. I don't want to put you on the spot for interest rates because I know you're not supposed to quote interest rates.
Yeah.
But
no.
What are we getting for interest rates right now? Like, what are you seeing? Good credit, bad credit, medium credit? What should people expect out there as a range?
I'm going to tell you that right now is the time. I bought my house a few years ago, and I'm telling you, this is a great time for interest. So, from, not so great credit to really great credit, I've seen as low as, we just booked one for 2.61, which is almost unheard of. So that was huge. But most of them are around 3%, relatively around 3, definitely under 5, which is very good. So.
And you're talking about home equities or mortgages when you
home
say
equities,
those rates?
mortgages, yeah, and they're all right now, and it changes daily, hourly, however, whatever you want to call it. But they're all waffling right now around the same.
Okay.
Yeah.
And I know, kind of from my experience, auto loan rates really don't change all that much. Even in, high interest rate environments, we don't seem to see them, especially not as high as what we see here on the slide, 8.5%. That's really high for an auto loan. So, can you give us a range on what someone?
Yeah.
I know some of it has to do with the more you borrow, the better your interest rate. Is that true?
It is true. It is true. The more you borrow, the better your interest rate is. It's how it is. But you just never know. So just reaching out, and it doesn't hurt to ask, what the going range is, because we're not going to give you an exact number until we have all your information and can give you, it for certain. But I can tell you, we looked at something we were shocked at because you don't normally see this. There was auto refinances the other day that were coming in at under 3%, which
wow,
rarely I haven't seen that. So you just never know.
Yeah. And auto refinances are one of those deals that you don't usually expect to pay anything as far as costs are concerned. So usually if you can get a better interest rate, it usually makes sense to
It does.
explore that option. I used to tell my clients, and I don't know if this is still true, go to the dealership, get the best deal that you can get and use their financing, and
Yep.
then come see us and shop around and see what you can get for a refinance rate. Little tip on your credit: as long as your credit is pulled for the same reason within a 2-week period of time, it doesn't have a negative impact on your credit score. So if you go to that dealership and they pull your credit at 29 different lenders and you end up getting a loan, and then you go and ask for a refinance within 2 weeks, you're fine. It's not going to have a negative impact. So you're probably going to get the best deal car shopping because you're using their financing, and then you'll end up with the best interest rate if you do the extra homework as far as refinancing the loan once you get it.
Yep. Exactly.
All right, great. And then, so I did want to point out, if you're curious if a consolidation makes sense, we're available for you to talk to, but there's also, you can see at the bottom, key.com. We have some great calculators out on key.com that you can actually input your scenario into, and kind of plug in some assumed interest rates, and see what the potential savings could be. So if you're not convinced by this slide and you just want to kind of run your own scenario, talk to us, or just go out to key.com and use the calculator. It's free for anyone to use. And you might be surprised at what you see. And you'll also get a chance to see what the going range is for interest rates right now. So with that, how else can we help? I mean, we've talked about how we can have a conversation. We've talked about how we can use the calculators. What advice would you have for someone, Sam, that's, kind of wondering if now is a good time to explore, taking advantage of today's low interest rates?
Right now, with this economy and everything, now is the time to make yourself a priority and to set time aside for you to take a look at your situation. We're in a great spot where now you don't necessarily have to come in. We are offering wellness journeys virtually, so you can do it from the comfort of your own home. If you have a significant other, they can join you. I'll just say we've seen it all. I mean, a lot of people, can be nervous about their situation, but the sooner that you act upon stuff, the easier it's going to be. So just make yourself a priority with, low interest rates right now. You might be surprised.
Great. Awesome. So the other thing I did want to just put out there, because I wanted to sort of address this again, and, we covered this on the last call, but I think it is important that, if you are on this call and you're thinking, well, this is all great, I wish I could do some of these things that you've talked about, but I need to improve my credit, or I just am having struggles making payments. Our advice is going to be, the same advice: is seek the advice of a professional and reach out to the companies that you do business with and ask for help. There's help available. It's not always advertised that help is available, but there are some definite programs mortgage companies have put in place. Your student loans, if you have student loans right now, any of the government loans that you have are probably in forbearance, which sounds really bad, but really all that means is that they're not accruing interest and you're not expected to make payments on those loans right now. They're not being negatively reported to your credit. So if that student loan payment maybe has been a burden for you and you just want to clean up a couple of things, maybe don't make the student loan payment for a couple of months. The forbearance is going to be good through the end of December at this point. They keep changing it, but at this point, that's what they're saying. And leverage that money in a different way so that you can maybe add to your savings or make some additional progress on those credit card debts that you have. That's another great way to kind of improve your credit score by reducing those balances. And in addition to that, the student loans that you might have, with a private company, if you don't just have government loans, there are options with the private loan companies to, in some cases, delay payments, defer payments, or even have a reduction in your interest rate because of because of the pandemic. So again, it's really important to ask the questions. Don't be afraid to pick up the phone and make a phone call. Especially when it comes to your student loans. And the last thing I'll say is, this is a question I get a lot, so I'm just going to throw it out there. The student loan forgiveness that you may be eligible for on your government loans, if you're on an income-based repayment, these payments that you're skipping through, not skipping, but deferring, I guess, through the forbearance, are counting toward your 120 payments for your student loan forgiveness. So if you're finding yourself in that, you do fall within the scope of having your student loans forgiven because you qualify. These payments that you're not making are still counting as payments that are being made. So I thought I'd just kind of throw that out there as well, in case you weren't aware of that. What other advice do you have, Sam, for those of us that maybe aren't in a position to consolidate, or maybe are in a tough spot right now when it comes to debts?
Talk to professionals. I'll say that, we're always here as a resource. And I'm sure that, the other institutions are the same. A lot of things that, people might not realize is I deal with building credit every day with people. Working through and making plans on, how we can get you to a good spot. So just make yourself a priority and reach out if you need help, and sooner is better than later.
I'm glad that you said sooner is better than later, because it's always easier to prevent something bad from happening than it is to try to, peel back something once it's happened. So thank you so much. So I'm going to go through some of the additional information, which is really just tools and resources as we kind of round out the call today. But I did want to just remind everyone that the chat is available for questions, comments, thoughts, or since we are a small group, if you're more comfortable just unmuting and asking your question live, we're okay to take live questions as well. So I'm going to keep talking, but feel free to put your questions in the chat while I just wrap up these last couple of slides. I wanted to give you this information in these last couple of slides because I think there's some great resources that we've kind of blessed and said, here's some additional reading that you can do if you attended today's call and you didn't exactly, hear, or you wanted a little bit deeper dive and you're not comfortable reaching out for an appointment. We want to make sure that we're providing you as much information as possible for you to be able to really take control of your financial situation. So I'll make sure that Joanna has this presentation material to be forwarded out with the recording, but these are some great information from some external resources that can really help you to get some questions answered in the environment that we're living in today. I also included here the student loan information that if you click on that link, it actually takes you right to the student loan .gov site, and I wanted to make sure that you had that so that if they do come along and they change that date, I wouldn't expect them to fast forward or make it the forbearance expire any sooner than December, but they might extend it. And so this is just a nice place for you to be able to click and say, what's going on with those student loans? Did it really expire in December, or was it extended? And then the last link in the presentation is a link for you to be able to schedule an appointment for a confidential discussion. So if you get this presentation, you decide you want to click on this link, what will happen is it will take you to a site which is going to use your, as long as you allow it, it's going to use a, I want to say MapQuest, or it's going to use your location. That's what I want to say, to find the closest location that's near to you in case you want to do an in-person appointment. If you don't want to do an in-person appointment and you just want to do the Zoom, probably the best thing to do is just to reach out directly to Sam, and she can actually send you the link to the Zoom meeting so that you can have the confidential discussion one-on-one, with someone you've seen their face before, and she can help you schedule that appointment. So I see that there are some questions coming in on the chat. It looks like Sam's jumping ahead and answering right
I'm trying.
right as we go. So, but for the benefit of the group, let's go ahead and just read the chat. So we did have a question. It says, do you have to have an account at KeyBank to do business with you regarding mortgages? And so Sam did answer that a little bit. She said, you don't need to be a KeyBank client. It will impact your credit score.
That's for the
Maybe
second
that's
question.
the second question. Okay. So no, you don't need to be a KeyBank client. In fact, but I will say if you are a KeyBank client, you'll get better rates. So, you know, throw that out there. Sometimes we encourage people to be a KeyBank client just to get the best interest rates. We are a relationship bank, and we do give our clients, you know, the best interest rates. There is a discount, if you will, that's available through this financial wellness program. And that doesn't require any type of KeyBank relationship. But yes, we don't require it. I know sometimes they make you have a savings account. Like I have had in the past loans with credit unions, and they say, well, you've got to be a member in order to have an account. That's not the case with KeyBank. You can have a loan with us and not have anything else. Although, like I said, you might get a better, or you will get a better interest rate most likely if you have a relationship. All right, so next question is, due to the recent events, I've had to put a lot of unexpected expenses on my credit cards. I am now at the max on my credit lines. Will this impact my credit score if I'm not able to pay? So Sam, I'm gonna let you answer that because you answered it in the chat, and then, so go right ahead and answer that one.
So debt consolidation might be a good solution for this. So it will impact your credit score. So when you utilize your credit cards and max them out, that is reported as having a high credit card utilization rate. We typically say to have around 30% on credit cards. That's what we call the magic number. So if you have anything above that, it can make your score go down.
So how would someone combat that? I have a couple of ideas, but what advice would you give to someone that they're at the max?
Yeah, so, you know, I would look at different options. So credit cards usually have high interest rates. So maybe doing a personal loan, doing a home equity line. Home equity normally is where I'm steering currently just because the rates are lower, but they change daily. That's where I would start, just knowing what I know right here.
Okay, good. Yeah, I mean, I would say in addition to that, if you don't have a strategy for that, make a plan. That's kind of the number one thing, make a plan. And it's going to be a little bit different for everyone. And remember that utilization is across all credit cards. So if you've maxed out one, but you've got two others that you're not really using at all, you might not be as bad as you think you are. So talk to someone, get a copy of your credit report. Annualcreditreport.com is a great place to get that, and use the resources that you have available. The next question that we have in the chat is, my daughter has a student loan and that is drowning her financially. Can you take out a personal, or what type of loan to pay it much easier locally? And then, so we'll get to the next question after that. So I'll kind of give my 2 cents, and then Sam, if you have anything to add on this. So if you're drowning because of student loans, the first thing to do is to look at the types of loans that you have. So if you have government loans or if you have private loans, those are really kind of two separate animals. And make sure that you're not going to be giving up any type of benefits before you consider a consolidation or a refinance. Student loan consolidations are actually, they need to be done in order to qualify for an income-based repayment plan. And all a consolidation does for you is it takes your average interest rate, blends the interest rates together, and gives you one payment to make on your government loans for a fixed period of time. You can apply for an income-based repayment. There's 3 different kinds of income-based repayments, and if you want more information about that, we can definitely get it to you, and it is available in that site in the link that I had provided in the presentation. Income-based repayments are basically what they do is they look at your income, they look at your expenses, and they set you up with a payment that's affordable, based on a period of time. The drawback with income-based repayments is that as you make more money, your payment goes up. And you can end up not making a whole lot of progress in the beginning towards the principal. You're basically just covering in interest, and sometimes the even interest ends up being capitalized. But the other option would be if there's been a hardship of any kind or a life event of any kind, you can have your daughter look at additional forbearance options if they're not government loans to basically defer those payments. Again, it's going to continue to accrue interest if it's not at 0%, but it might be, if it's a short-term problem that you're experiencing or that she's experiencing, it might be, a good solution for the long term. Typically, banks won't let you refinance student loans with a personal loan. If you go into a bank and you say, I want to apply for a loan and I want to include my student loans, the minute you say student loans, the banker's mind is going to shut down. And the reason for that is because there's so many benefits of keeping a student loan as a student loan that there's just risk ramifications if a banker at any bank doesn't do what's in the best interest of the client. And if you don't understand the full picture, or life changes down the road, you wouldn't want to put the client in a worse financial situation. So I've yet to see a bank that will let you refinance a student loan into a personal loan, but there are definitely some personal loan refinance companies out there that could potentially help. And they will, in some cases, allow parents or other co-signers. So hopefully that answered your question. If not, feel free to put follow-ups in the chat. And Sam, did you have anything to add on that?
No, Michelle, you nailed it right on the head. With student loans, there's a lot of different options out there to make it manageable, because I know there's a lot of people that are drowning in student loan debt, but there's a lot of options out there. And like Michelle said, if you want some resources, we can send them.
Absolutely. All right. And then someone, same person, how long do you have to be a member to get better interest rates? Another great question. You don't have to be a member for any amount of time. You can, open your account the same day you apply for your loan. And I think I just saw an update. You have to be a member before it's approved, I think,
before
now
it's approved
at this point. But it doesn't require any extensive account being an existing client for any period of time other than before your loan's approved.
Yep.
All right. Any other questions in the chat? Good questions. I love it when we have questions.
Me too. I love it.
All right.
We have another one.
Just refreshing here. Oh, yep, we do have another one. What are your thoughts about having several checking accounts for separating bills and expenses? I use envelopes with cash from each check to separate my expenses. That way I don't overspend. Is there a better option for me to use? Sam, I'm gonna let you take that one.
Yeah, I see a lot of people using this method because people don't want to overspend. I mean, that's a thing, right? So you have your debit card, and I'm one of those people, and I swipe. So I've seen people use that method, and I mean, I think it depends on the person. So, but something that I have been recommending a lot to people would be the cashback credit card. That was what I was thinking of. So a lot of people don't want to overspend what's in their checking account because that can get you overdraft fees. They don't know all the automatic payments that are coming out. It can just kind of wreak havoc on your checking account and just not knowing exactly what's there. So a lot of people have been using a credit card to spend, you buy your groceries, buy your gas on the credit card, and then you just pay it back. So I've seen that way work somewhat better because then you're really not overspending. You don't have really an option to overspend. It's a lot easier to track. and also you're getting benefits. So, you know, back to the envelopes and using cash, you're not really getting any benefit from using cash. But if that works for you, then, and it's how that you manage your money. Everyone manages money differently. But what I'd say to that is you're not, especially if you get cash back on the credit card. Yeah, so is it benefiting you? If you can manage having a credit card, then I would say using a cashback card would be the best option.
Great. I think we have some agreement in the chat. So someone said this works really well for me, especially if you get cash back on your credit card. I can tell you, I have my own envelope system, but they're not envelopes, they're checking accounts. So I've got, you know, a checking account that my mortgage money, you know, gets direct deposited into every time I get paid. I get paid twice a month. Half the mortgage payment goes in at the beginning, half goes in at the end. When the time comes to make my mortgage payment, it's all right there. I don't have to worry, you know, that I accidentally overspent my mortgage money, because it can be easy to do that, right? Same thing goes for the car payment. You know, any fixed expenses that I have, I do, it's my envelope system, but it's electronic. It just gets direct deposited into the appropriate account. So when the time comes, I don't have to worry. And to your point, that spending account, you know, I swipe and I swipe for all of the, you know, the trips to Walmart, or, you know, the things that I maybe are not being as diligent about, that extra spending that gets away from us sometimes.
I will tell you, there's something else that I've seen a lot of people do, and it's having two checking accounts. They'll have two checking accounts with us, and one will be for the automatic payments. And so that's how they kind of split up their money. One is the spending account, and then one is the automatic payments, and it's, you know, set payments, so they know exactly what's coming out. So it really is what works best for someone. And I mean, it's trial and error, right? So.
That's right. That's right. And, you know, you're right. Whatever, as long as the method works, you know, that's the most important thing. And whenever you can get benefit from your method, even better, right?
Exactly.
Okay, well, we do have a little bit more time left, but I also, you know, want to be respectful of everyone's time. So I don't see any additional questions in the chat. If you have a last minute question, again, feel free to throw it in there. Otherwise, I'm going to let Sam kind of round us out with some closing thoughts for the call.
Yeah, so thank you, everyone. There's some really great questions. Thank you for participating. You know, make yourself a priority right now. Now is the time, with everything the way it's going in the world right now. Just to kind of have a plan in place, see where we can save money. Make yourself the priority. We find that, you know, people are being reactive instead of being proactive, and we're here to support all of you. So thank you guys so much for having me.
Yes, I couldn't agree more. Thanks again. I think we've got another meeting coming up in a few weeks, so I look forward to seeing you all again. And if you aren't able to join the live meeting, feel free to join us for the recording, but it's always nice to have live participants on the phone. And, you know, thanks to Joanna and the team. I appreciate you know, the partnership that we have. As a reminder, if you do want to schedule the Zoom meeting, that, you know, you're best to just reach out to Sam directly. Otherwise, you can use the appointment scheduler or any resources that are available to you through key.com. But I hope everyone has a great rest of their Thursday, and thanks again.
Thanks so much.
Thank you.